Have you ever thought why you're taking a trade before entering a trade? Now, when I ask that question, most of the retail traders doesn't have an answer for that. Now, most people confuse that support resistance is all about drawing lines. First, we should know why it is forming as a support and why it is forming as a resistance. Hi there guys, welcome back. This is Kishore here, founder and CEO of Trade Achievers. So in this video, we are going to discuss about what is support and resistance and how a support resistance is formed. So most of you would have known about support and resistance. So if you don't, I will explain about it. Consider a market is falling down. Even if it falls, it would never become zero. It has to stop at some level, and that level is called support. Similarly, a market will not go up continuously. It has to stop at some level. Now, that level is known as resistance. For example, in simple terms, level which stops the market from moving down further is called support, and a level which stops the market from moving up further is called resistance. Now, most people confuse that support resistance is all about drawing lines. Think wisely before doing anything. Understand things completely before you act on them. Simply drawing lines on a chart will not create a support and a resistance. If so, how does support resistance forms? How do we draw them? Have you ever thought about it? If you don't know the answer, let me teach you in detail. So few traders, what they do is they draw some random support levels by themselves, and next time when the market hits these levels, they consider the market isn't buy because the market has hit that level. So first of all, they don't know why the price has hit a particular point. They blindly believe that to be a support level because the market has touched that level. First, we should know why it is forming as a support and why it is forming as a resistance. So let me tell you why it is forming as a support resistance is because of human emotions. So we have to clearly understand that first. So support and resistance is not about lines. Support resistance is formed because of human emotions. So now people may be confused about that. What does human emotions have to do with the support and resistance? So to make it more understandable, we shall see it with an example. Let's take for example gold. Let's consider the price of the gold is at 4,500 per gram. So many people start buying gold at that price. Now what happens is when more people start to buy at 4,500 per gram, there will be a demand for that product. So obviously when product is being purchased again and again, it creates a certain amount of demand for that product. So automatically what happens is that product's price will increase. So the price of gold will start to rise from 4,500. So this level is considered as a demand level, and can be also said as a support level. So now you may ask, who is supporting that market? It's nobody, but the people who bought the product because of that demand. What is actually happening is people think that 4,500 rupees is a low price and start accumulating gold, and it creates a certain demand in the market. Now what caused the people to buy? That is the important question. What makes a people to buy at certain price? It is because of human emotions. About 95% of the retail traders trade with emotions. Now, have you ever thought about that? Why you're entering a trade before even entering a trade? I used to ask this question a lot. Have you ever thought why you're taking a trade before entering a trade? Now, when I ask that question, most of the retail traders doesn't have an answer for that. So I'll tell you how emotions work in the market with a simple example. See, if we consider our working habits, there are two types of intuitions and rationality. Say, for example, we have two emotions which plays in our mindset while we are trading. One is intuition and the other one is rationality. Now, what does our intuition does is, it drives us to take a decision at the spot of a moment. It's like an instant decision. You try to take a decision at an instant. Now, rationality, what it does is, it guides us to perform a complete analysis about something before taking a decision. Now, 90% of the traders trade based upon intuition, but that should not be the case. That is the problem which causes most of the retail traders to lose money in the market. Now, have you ever thought about a trade before entering it? Now, most people think about their trades only after they have entered the trade. They don't think before entering. They try to think about it only when they start to get some losses. Now, what happens is they take a trade, and after it starts to getting into losses, we will follow news. Next thing is they'll start to go and start check all the news as what is happening to that particular script, and they'll start analyzing and look for experts' opinion, what is happening with the script. Now, had we done the analysis earlier, we would have not faced these losses. That's why I say most of the people trade because of intuition. Getting it? So most of the retail traders are trading because of intuition. Now, in this scenario, most of the traders thought the market will go up, and they started buying the product, which in turn creates demand for the product. So the prices increases and market goes up to 5,000. Now, when the market reaches 5,000, the trader who bought at 4,500 will consider 5,000 to be a high price and want to make profit out of it. Now, as market reaches levels like 5,000, 6,000, now we consider these are like sentimental levels. Now, people will think that the market is going to fall down. Now, we will try to fix in our mindset that the market will fall down as soon as the price reaches a higher level, and we will start selling it. Now, once we start selling, what happens? A supply is created in the market. The price point where supply starts in the market is known as resistance. So, who prevented the market from going up? It's the traders. See, the actual traders, once people started selling thinking 5,000 is a higher price, a supply was created in the market, which led to drop in the price. Now, that area, in a technical term, we call it as resistance. So, the traders placed buy at 4,500 started selling at 5,000. So, 4,500 will act as a support level, and 5,000 is going to act as a resistance level. But a retail trader might ask, no, I see a support and a resistance in the middle. Now, we have to know why they are formed. So, let's see about it. So, let's say we have bought at 4,500 and sold at 5,000. Now, we made some good profits. For someone who bought at 4,500, 5,000 is a high price. But consider someone is starting to watch the market. Now, let's say a new fellow is coming inside the market and he is seeing the market at the price of 5,000. Now, the market falls as most people sold their position. Someone who sees the market at 5,000, the market falls to, let's say it has come down to the level of 4,800. Now, for this new fellow who came into the market, what will be his mindset? Whether that 4,800 is a low price or a high price? Yes. So, if somebody who is following the market since 5,000, 4,800 is a low price for him. So, he starts to buy the product, like for example in this gold. Now, what happens is, just imagine what will happen to the market. Will the market start going up? If one person who thinks the market is in low and he starts to buy, no, certainly not. It will not go up. As I said earlier, we depend upon our intuition to trade in the market. Many people will think on similar lines to us. That is what happens in the market. Now, we think we are the only participant in the market, but for example, if you check the statistics of Pan India, suggests 2% of the population is trading in the markets. Now, out of that 2%, how many would think that market would go up from 4,800? Now, when those people start to buy out of intuition, let's say a group of people thought it is starting to go up, and they start to buy and buy, what happens is a demand, a support is being created. Now, what happens when the demand is created? Obviously, the price starts to move up. Now, consider now the market has reached 5,000. For someone who saw the market at 5,000, 4,800 was a low price. So, he started buying. Now, as soon as the market reaches 5,000 again, what will he think? he will think about selling the product. If the one who bought at 4,800 sold at 5,000, what happens is a supply is created again. So supply, in other words, will act as a resistance. So once a resistance is formed, a supply is created and the price will start to fall. So one more thing to know is institutions buy at the bottom and sell at the top. See, the major institution which move the market, they buy at low and sell at highs. So institutions will be trading the market only at the major tops and major bottoms. This is why we call them as major supports and major resistance. The level in the middle form, so for example, a support resistance which is formed at the middle of these major resistance and the major support, it is formed because of human emotions. So they are known as minor supports and minor resistance. For example, let me show you an example. Now this is a crude oils chart. Now most of the retailers use lower time frames like 15 minutes or 1 hour to analyze the market, but most of the institution, they use monthly chart. So I have spoken about this in our shows as well. Mostly traders generally don't look at monthly chart. My suggestion is start with monthly chart to plot major institutional level of support and resistance. So this is our monthly chart. So we do have a reason why market moved to such highs and lows. I will explain them now. This chart has a data from 2009, but we are not to go to check those. We are going to check some history levels. Now we are going to plot support and resistance for the past data. Now if we plot support and resistance, we have plotted support and resistance in the year of 1983. Now we have plotted support resistance for let's say now it's 57 years from 1983 to 1990. Sorry, up to this. So we have plotted support and resistance in 30 years in the past. Do you see? Now as we can see, lots of support and resistance. I will now explain the logic behind the peaks and bottoms. 30 years ago, human emotions made them to buy at this point. Now after that point, the price fell down and reached $10. Now the people took decision to buy around that bottom and the institution sold around $40. So these are the institutional buying and selling points. They buy at low and sold at higher highs. Now we have checked these in the past and it all looks fine. Now we will move to the current market and change over to the candlesticks. If we check, these red lines were plotted 30 years in past and it is even working now. The market crashed in 2008 and just look at it. It took a support at a certain level which acted as a support in 2000, which is acting as a support at 2008. So what is forming these support and resistance is none other than the traders. Now we think that the market will go up from a certain level. So what do? We buy or we sell because of what we think, and that's why support or resistance forms in the market. Now do you getting it? See, most people don't know what is support and resistance. All they know about support resistance is all about drawing lines in the monitors. Lines do not form support and resistance. It is because of human emotions. Traders and their emotion have a major role in forming a support and a resistance. Now we will see how this is happening historically in the charts. Now we will see one more example about Bank of Baroda. We will go with the Indian markets and the charts appears normal. Now when we plot support and resistance, we can see a peak which is formed in 2008. Now this level acted as a support, a resistance. So what did the institution think? They thought that was the high price and sold the market at this price. And when the institution sold, the market crashed and came down. But do you see where the market came? Where did the market go again? It came to the support where major players had bought the markets earlier. From that point where institutions bought earlier, the market took support and the market went up. This is all because of the participation of the major players in the market and human emotions. Now, I have to show you one more thing. The market took resistance at a particular level in 2007, and in 2013, now this price acted as a resistance in 2007 is acting as a support in 2013. Now, those who thought the price was high in 2007 are now thinking prices are low in 2010. Those who thought the price was high in 2007 and sold at 93 rupees now think this is low price in 2013 and started accumulating that share in 2013. Now, do you see it? As I said, support and resistance forms because of emotions in the market. And the thing is, support and resistance is all about human emotions. So we have to come to a conclusion that those people who traded about 80 years ago are great. Now, if we are asked about greatest traders like 60, 80 years ago, what people will say is, we will say Jesse Livermore. In 1920s and 30s, we had a great traders like Jesse Livermore, Richard Wyckoff, and William Delbert Can. So we consider these are like the most successful people, and they are the greatest legends of trading. But what people forget is about the retail traders. By our mindset, we will always look at great things and fail to concentrate on finer details. Now, I'll give you an example. If we are asked about the greatest trader, investor in the 20th century, who will be, who we will take in as an example is, it's obvious everybody will say the name of Warren Buffett. Now, just fast forward to 100 years from now, what will they say? 100 years ago, there was a great trader, his name was called Warren Buffett. That generation will think of us to be a great traders. And the future generation will take inspiration from Warren Buffett and will be wanting to trade like him. But we know what we are doing now. Our retail traders trades today without proper reason and he'll be losing money on the trades. Now, the future generation will only see Warren Buffett, but they will skip the finer details about retail traders losing money today. Now, we also do the same with the past generation. We only see Jesse Livermore and believe that about 100 years ago, we had great traders. We skip the fact that retail traders were there too and they were losing money. Now, why did the price take support at the same level as it did 30 years ago? It's only because of human emotions. First of all, understand this. Now, please keep this in mind. There is a quote, "Time changes, people never change." The meaning is, time keeps on changing, but the behavior of people never change. That is especially true in trading world. Traders who lived about 80 and 100 years ago would have taken trades based upon intuition as demonstrated today. So, from the bottom, the institutions accumulated and took the market to the new peak. Likewise, institutions were buying and selling at major lows and major highs. We, the retail traders, go into and we try to come out of the markets in the middle. So we need to know why support and resistance is formed. Now, I hope you would have understand how a support and resistance is formed. It's not about drawing lines. A support resistance is formed because of human emotions. Now, so always try to keep this in mind. Now, if you are going to do something, my suggestion is you should completely know what you are doing, right? Or else we can end up in losses. See, there is no point in blaming the support and resistance because the mistake is ours. The problem is we have only the information and don't have the knowledge to use that support resistance properly. That is why we end up in losses. So I hope you understand now how support and resistance is formed because of human emotions, as we saw about plotting and support resistance. In case if you want to know how to trade using support resistance, what we were seeing is how support resistance is formed. There is a difference between a forming and trading. So if you are if you want to learn more about how a support resistance is formed and how we have to trade in that, so we at Trade Achievers, we teach people on how support resistance should be traded, and we teach 14 subjects of technical analysis on how you can approach the market with different types of technical analysis. See, I used to always say there is always a reason for the market to go up and there is always a reason for the market to come down. So we have to know the reason, and once you know the reason, if you take a trade, it's a profitable trade. So that is my advice. So I hope this video was useful. Now you would have known how a support and resistance is formed. So thank you very much for joining. Take care.